Good morning, friends. So we are starting this third day of our refresher course. If you recollect, we started off essentially with the concept of digitalization, which is changing the world very fast, especially in the COVID scenario. The digital era has gone on a fast track. We also saw the equalization levy that came in first of all on the advertising and then even in the goods and services. We also saw Pillar 1 OECD, which is under construction, which essentially says that you have to go to the level of consumption where actual consumption happens, and that country should also get share in their taxes. On top of it, we also saw Pillar 2, which essentially said that irrespective where you are based, at the end of the day, your corporate tax at the parent level taken together should be at 15%. And if it is lower, then the parent company has the power to charge the differential or other parent company's country has the power to charge the differential rate of taxes. Thereafter, if you recollect, we also went ahead and took forward the impact of COVID essentially on transfer pricing. What are the types of adjustments? How do you get the data extracted? How you do the best comparable search, and what's going to happen? So that was something very interesting that we went through. Thereafter, we went into the disputes in international tax. And those disputes primarily were not only local, but also international. And we had a couple of international, people with experience with international actual practical structurings and disputes. So that panel discussion we did cover. So today we are getting into an interesting topic, which is essentially substance over form. If you recollect, in our good old days, we were always taught that you cannot lift the corporate wheel and that a company is different from the directors and the shareholders. However, that corporate will is now being lifted everywhere, including at the OECD level. And substance is being looked upon. We had several cases, including the Azadi Bachao case on this area. However, as the international tax has developed over a period of time, people realize that, yes, you need to have substance. In the initial years, if you recollect Mauritius and other countries, we had seen scenario where only certain people at a junior level were kept. And, it was framed as if you have substance. But that has also moved ahead. And now people functions. Exactly what are they doing? What are their qualifications? Do they have the decision-making power? Do they have the risk appetite? All that is being considered. And for that, it's very important now to understand what is this substance. When you say substance, it's a very, very wide term. And when you are taking away the corporate wheels and the form is no longer important, the agreement is no longer important, it is just a starting point. It's very important for us to understand what is this substance. We also have other norms for it, like place of effective management. We also have GAR coming in. So who can be a better speaker for us to explain all these issues and the evolution of transfer pricing as well as international tax to move away from the basics of form to now evolving substance even. So we have Anish sir taking up this particular session. Just to briefly introduce Anish sir. Welcome, Anish sir, first of all.
Thank you, Rakeshji. Thank you very much.
You're very much welcome, sir. So friends, just to give a brief introduction, while everybody knows Anish sir, he has been a regular speaker at the institute, but for the young chartered accountants who are cleared in pandemic, really, Anish sir has been our institute's favorite speaker and has been speaking regularly. He has a 30+ years of experience, right from advisory to compliance to even the most complicated litigations. He is currently also the president of the Chamber of Tax Consultants. He is regular speaker at various forums and even on business news channels. He has written several articles in reputed journals, and he has also edited a book on royalties and fees for technical services. So once again, welcome Anish sir to this Session. The floor is yours.
Thank you very much. Morning, everybody. Warm welcome on this Saturday morning to this refresher course on international taxation. And thank you, Rakesh ji, for the kind words of introduction. It's always a pleasure to speak at the Institute's forum. The Institute, as we all know, is our alma mater. And to be able to share experiences, to be able to share, whatever I have learned during my limited interaction with the tax world, and to learn from everybody else is a great experience indeed. And the Institute always has been at the forefront of disseminating education. And therefore, I would believe that, it is indeed a privilege and a pleasure to always speak at the Institute's platform. And, this is one platform which I never refuse to speak at. So thank you very much. Few ground rules. I will share a PowerPoint presentation, but at the time of sharing of the PowerPoint presentation, my video will be off. As you all know, I have high myopia. And therefore, for me to be able to look at the presentation and keep the video on is going to be a little difficult. But during the Q&A and during this opening remarks, I will, keep the video on. So really, what is, and Rakeshji was, very rightly alluding to, where have we moved from substance, in the journey of substance over form? And there was a time, rightly as Rakeshji put it, where the thinking both at the taxpayers' end as well as the judicial end was that you look at only the legal form of the transaction. And the classic case, as we all know, is the Duke of Westminister's case. For all of you who don't know, what happened was the Duke of Westminster had a large mansion. And in that mansion, he employed a gardener and 6 other household workers. Now, he had a very creative tax advisor who said, why don't you claim a tax deduction for the salaries that you pay to your gardener and to the 6 household help? And, somewhere the Duke also was curious to say, ye kaise ho sakta hai? So they devised a agreement between the Duke and the staff members to say that in consideration, rather than paying, wages to this gardener and to the 6 household help, you devised an agreement whereby for past services rendered every week, and in the Western world, it's generally a weekly salary, particularly at the household help and the gardener level. So every week, the Duke would pay them a certain amount. And the Duke then claimed a deduction of that, because at that point in time, and this is we're talking about the 1930s, mind you, in the 1930s, this was actually allowed as a tax deduction back in the UK. And therefore, the Duke actually claimed a deduction. The tax authorities or the Crown, as expected, opposed it, saying that this is a colorable device that you're using. This agreement is nothing but a sham. These people come and work with you, right? They work at your mansion and they continue to work. And you can't pay them for past services, because what you're doing is in substance really paying them for the services that they are rendering today. And there, somewhere the matter went up right to the House of Lords. And at that point in time, rightly or wrongly, the House of Lords actually held that nothing doing. You have to look at the legal form of a transaction. There is a covenant between the Duke and his staff, and the Duke is entitled to a tax deduction because the covenant says that this amount is being paid to the staff in consideration of past services. So, that's how the law started. And that's how this whole philosophy started of looking at the legal form of a transaction. And if you will see even Indian jurisprudence of that era, you will see that somewhere this has been looked at. Now, even in England, the ratio or the principle of this Duke of Westminster's case in recent or later decisions has actually been diluted to a significant extent. As also in India, of course, we are aware of Vodafone, where the learned judges actually said that you have to look at and not look through. So we will look at some of all of this when we touch upon the presentation. And with that, let me share my screen with you such that we are able to go through this in a little more detail, and we will then come to the principal purpose test and the ratios associated with that as well. So with that, if I may just give me a second, please. Sorry. First, let me stop my video and then do the screen sharing. Just 1 minute. Yeah, so here's my video off, and now let me share the screen. Oops, sorry, I ended up closing the window. Give me a second. I'll just stop share for a moment and then open the window and come back to the share. Sorry for this little technical glitch. There we go. Okay, now let me start sharing the screen. Here we are. Do slideshow. Oops. Yes. Slideshow from beginning. Yeah. Can everybody see the screen? Okay.
Yes, sir. We can.
Yeah. So let's move on, to what we are going to deal with today. We will start with the judicial evolution of the anti-avoidance rules. We will move on to GAR. We will then give a very short overview, very 2-minute overview of the MLI, delve into the principal purpose test, look at the interplay between principal purpose test and GAR, look at it practically, this interplay in terms of 3 case studies, and then at the end, just take note of 2 or 3 advanced rulings which have come, which have dealt with this principle. So with that, let's start off with the presentation. Again, what is, whether tax avoidance is moral, legal, should you always choose a method that gives you the least tax liability, is a question that has been plaguing all of us ever since the word tax planning was coined or introduced. And there, if you see the old English decisions, which the first one was Fisher Executors in 1926. Again, there the House of Lords said that the subject is entitled to so arrange his affairs so as to not attract tax imposed by the crown so far as he can do so within the law. And if he does that, really he neither comes under liability nor does he incur any blame. So it's a very strong statement by the House of Lords way back in the 1920s. And then it was followed by our celebrated case of Duke of Westminister, where the House of Lords, particularly Lord Tomlin, went and said that if a taxpayer succeeds in arranging his affairs in a manner that he has to secure the result, howsoever unappreciative the Commissioner of the Inland Revenue or his fellow taxpayers may be, of his ingenuity, he cannot be compelled to pay an increased tax. So, we saw the context, the covenant between him and the members of his household staff. And there the deduction was allowed, saying that, somebody's done something ingenious, you have to give it to him. So at that time, the thinking was different. However, let's look at the situation again about 50 years later in a case called Furness versus Dawson. Before that, of course, in a case called Ramsay, way back in 1981, the principle of Westminister was diluted. But there were very strong observations made by the House of Lords in Furness versus Dawson. And if you see Lord Roskill's utterances, it says, when the ghosts of the past stand in the path of justice, clanking their medieval chains, the proper course of the judge is to pass through them undeterred. 1936, a bare half century ago, cannot be described as part of the Middle Ages, but the ghost of the Duke of Westminster and of his transactions, be it noted a single and not a composite transaction with his gardener and with other members of his staffs, hounded the administration of this branch of law far too long. I confess that I hope that the ghost may have found quietude with the decisions of Ramsay and in Burma. Unhappily, it has not. Perhaps the decision of this house in these appeals will now suffice as exorcism. So again, when you talk to tax practitioners in the UK, which is the home country of the Duke of Westminster, they have very clearly said that the Duke of Westminster is dead, buried, and buried far under the ground far too long ago. And therefore, don't even talk about Westminster because the world has moved on till then. And this is really how it works in the UK. But as far as we are concerned in India, we held on to the Duke of Westminster principle till McDowell came in 1985. And there, very clearly, this was a departure from the principle of Westminster. And very clearly, the Supreme Court held that any tax planning that is intended to result or results in tax avoidance must clearly be struck down. Colorable devices cannot be part of tax planning, and it is wrong to encourage or entertain the belief that it is honorable to avoid the payment of tax by resorting to dubious methods. It is the obligation of every citizen to pay his taxes honestly and without resorting to subterfuges. And this is a very big departure from that principle which was laid out in the Duke of Westminster, where clearly it said that whatever way you find within the four corners of the law, if you are going to find a way, and that legal form has to be accepted. So really, the Supreme Court actually then said, thus the ghost of Westminster, in the words of Lord Roskill, has been exorcised in England. We just read out Lord Roskill's passage from Furness versus Dawson. Should it be allowed to raise his hands in India? And then the judges said, we think the time has come for us to depart from the Westminster principle as emphatically as the British courts have done, and to disassociate ourselves from the observation of Shah and similar observation made elsewhere. Right? The evil consequences of tax avoidance are manifold. We must recognize that there is behind taxation laws as much moral sanction as behind any other welfare legislation, and that it is a pretense to state that avoidance of taxation is not unethical and that it stands on no less moral plane than honest payment of taxation. So very clearly, the Supreme Court said nothing doing. If you are going to engage in a arrangement or series of transactions which result in tax avoidance, which are colorable in nature, obviously the courts will look down very hard upon such things. So the one extreme obviously was that everything is legal if it has a legal form. The other extreme is here in McDowell, which says that we will not permit anything which even remotely looks colorable. And the balance of that somewhere was achieved in the latter decisions of Azadi Bachao and Vodafone, where basically in Azadi Bachao, the Supreme Court said that something which is otherwise valid in law cannot be treated as never being happened, as non-est, merely on the basis of an underlying motive. So even if you know that the motive is to avoid taxation, if there is something which is legal, and we all know that Azadi Bachao was rendered in the context of a Mauritius resident claiming Mauritius treaty benefits. And that was a public interest litigation to say that this Mauritius treaty basically has tax avoidance inbuilt into it, and therefore, treaty benefits to all the investors coming from Mauritius should not be allowed. And it said that the Supreme Court said, in the absence of any clause on limitation of the treaty relief, a resident of a third nation cannot be denied the benefits of a treaty. Because again, the argument of the petitioner there, Mr. Shivkant Jha, was that this is being misused by residents of third countries who set up vehicles or companies in Mauritius to invest into India and claim the benefits of the treaty. And the court looked at the treaty and the preamble of the treaty, which said that the treaty was also enacted or was also entered into for the purpose of fostering trade and economic relations between India and Mauritius. And therefore, they said that since one of the objects of the treaty is also to promote economic relations between the two countries, really, even if a third country resident accesses Mauritius as a holding jurisdiction and sets up an entity there to make investments into India, we will not, look at denying the treaty benefit. Many principles in fiscal economy, which though at first blush might appear to be evil, are tolerated in a developing economy in the interest of long-term development. So the court also looked at the fact that India as a country needs foreign investment, and that foreign investment has to come in because there's a crying need for foreign capital into the country to develop the country, both in terms of infrastructure as well as in terms of manufacturing, services, trade, etc. And therefore, it is tolerated in this sort of a developing economy. The treaty has been entered into with a conscious decision that I want to get in for an investment into India, and therefore I will not be able to deny treaty benefit to a resident of a third country. Whether treaty shopping should continue and insofar as how long, the discretion is that of the executive. The judge or the courts, will not decide that. The treaty shopping, ultimately, how long it has to continue is a decision of the parliament who has sanctioned the entering into of the treaty. And they also made a small comment on McDowell, which said that McDowell could not be read as laying down that every attempt of tax planning is illegitimate and cannot be ignored. So I said that this is the classical balancing between the Duke of Westminster on one hand and McDowell on the other, to say that, all right, you look at the broader picture. You don't look at only the transaction, as Rakeshji was very, very clearly mentioned, that you have to look at the broader picture. You don't have to look at a particular arrangement. You have to look at the context, the whole object, the whole purpose of entering into that particular arrangement, and then decide whether that arrangement is an arrangement of tax planning, an arrangement of tax avoidance, or an arrangement of tax evasion. And we will deal with these terms just in a little bit. And of course, we had Vodafone, which basically said that there was no conflict between McDowell, Azadi Bachao, and Westminister. Azadi Bachao really brought McDowell on the one hand and Westminister on the other hand into their proper context and gave the right balance. A taxpayer is entitled to arrange his affairs so as to reduce tax incidence. And, there were situations like we invest in savings instruments to claim an ETC deduction. Is that something that is a frowned upon arrangement? I would believe not. So the court really said it in that fashion. And it said that a revenue cannot look through a transaction in the absence of enabling legislature, which is what ultimately was the precursor to the enactment of GAR. Though if you see the 2009 draft of the Direct Taxes Code, the concept of GAR was already enshrined in that draft law. But ultimately, this is what led to the introduction of GAR in the Finance Act 2012. And really, the genesis of GAR is that tax avoidance is the result. And, these are really the three terms that we're going to look at. What is tax avoidance? What is tax evasion? And what is tax planning? And tax avoidance is the result of transaction or actions taken by a taxpayer, none of which or no combination of which are illegal or forbidden by law. So tax evasion is something which is illegal. Avoidance is not paying taxes or paying lesser taxes while staying within the law, whereas evasion is generally the result of illegality, suppression, misrepresentation, and fraud, and involves outright concealment of transactions or non-disclosure of income or similar acts. So, not showing a particular receipt in your tax return is evasion. Claiming that particular receipt as not taxable is tax avoidance if there are good grounds to support it. And what is planning? Planning is an exercise undertaken to minimize tax liability through the best use of all available allowances, deductions, exemptions, exclusions, etc. So to take a very recent example, we have the whole concept of the International Financial Services Center. And government has provided, as you all know, an exemption for overseas funds to migrate into the International Financial Services Center. This was introduced as recently as the Finance Act 2021, which is why I'm taking this as a classical example so that the memories remain fresh. In that situation, when we move operations, say there's a client who comes to us and we advise him to move operations from his home jurisdiction, for example, Singapore, into, say, the IFSC, particularly as Rakesh ji was mentioning, that there are people sitting somewhere, right? There are people sitting in India, which can lead to some sort of allegation of constitution of a permanent establishment. And we move these people into the IFSC and we move the fund management into the IFSC. Then are we engaging in tax avoidance or tax evasion? I would think not. What we are doing is tax planning, because the government has, with a conscious purpose, allowed the migration and has provided for that migration to be tax neutral. And also the government has then provided a deduction under Section 80LA for the next 10 years or 10 years out of the first 15 years of the operation of the IFSC unit, for you to be able to actually use the Indian infrastructure, develop the Indian economy, create the ecosystem around the IFSC such that you generate employment, you generate business for smaller vendors of many things, etc. So that's a conscious decision that the government has made to forego its right to tax. And that is planning if you use something like this. As far as Indian judicial decisions are concerned, tax planning has always been, favored by the Indian judiciary as compared to tax avoidance or tax evasion. There are cases like McDowell where an attempt to avoid tax has been, frowned upon, and we will see some of the advanced rulings at the end, even recently, which, though rendered in a pre-GAR era, somewhere seem to recognize and appreciate the principle of substance over form. Okay, and GAR then, therefore, because of the observations of the learned judges in Vodafone, was introduced to deal with cases of what they call aggressive tax planning, tax avoidance, and codify the doctrine of substance over form. So now we have a codified GAR. And what does GAR say? GAR says that an arrangement is an impermissible avoidance arrangement if that arrangement has, number one, the main purpose of obtaining a tax benefit, and tax benefit is widely defined to mean any decrease in tax liability, increase in refund, increase in carry forward losses, etc., whether by use of a treaty or without the use of a treaty. So it's a very wide definition to say that if your main purpose of entering into a particular arrangement, and arrangement is again very widely defined as, a transaction and a trust, an agreement, whether oral or written, etc. So again, if the main purpose of doing something of a taxpayer is to avail of a tax benefit, plus it satisfies one or more of these four conditions, right? Which is the tainted element presence, which basically has four limbs. One, that it creates rights or obligations which are not ordinarily created by persons dealing with arm's length. So clearly, you are not dealing with a party and this doesn't need to be related party, mind you. This could be a completely third party. But if you're dealing with him in a manner that you would not deal ordinarily at arm's length with any other party, then if your main purpose is that of obtaining a tax benefit, plus if you deal with that party in such a fashion as we described, then GAR would apply. Alternatively, GAR would apply if main purpose obviously is there, but the arrangement results directly or indirectly in the misuse or abuse of the provisions of the Act, including the provisions of the treaty, because the treaty by virtue of section 90 is as much part of the Act. Now, misuse and abuse are terms of criminal law, and they would imply an element of mens rea. So this would go into the realm of tax evasion rather than tax avoidance. The first element of not dealing with arm's length may go into the realm of tax avoidance, but the second element, I would believe, would go into the element of tax avoidance. Third, it lacks commercial substance or is deemed to lack commercial substance in whole or in part, and we will come to when does an arrangement lack commercial substance. Basically, when it involves an accommodating party or where the residence of a particular individual or an entity is shown to be something which is different from the normal ordinary residence of that particular person. So a lack of commercial substance is the third element. And the fourth element is entered into or carried out by means in a manner which are not ordinarily employed for bona fide purposes. Again, a very wide term, but basically this is a very factual exercise. The applicability of GAR or otherwise is a factual exercise. It will have to be determined looking at the facts of each case, the alternatives that were available to the taxpayer, the counterfactuals that he can actually demonstrate to say that why was this particular arrangement not done in an alternative manner. That would become very important. So then to, look at some of the terms. Again, we said tax benefit has been very widely defined as reduction, avoidance, deferral of tax, increase in refund of tax, even if it is as a result of a tax treaty, reduction in total income, including increase in loss. So tax benefit is defined in a very, very broad manner. Commercial substance fails if substance of an arrangement is inconsistent or differs significantly from its individual steps. So you may carry out steps in a particular series of transactions which are perfectly legal, but the substance of that accumulation of those steps is different from that of the individual steps itself. Then obviously, and we'll come to some examples of some of all of this, in the subsequent slide. The arrangement includes round-trip financing, accommodating party, offsetting elements, etc. So again, round-trip financing is defined and accommodating party is defined, again, very, very broadly. And locating a transaction or an asset or a place of residence for a tax benefit without substantial commercial purpose. So essentially, you will have to look at why has a particular transaction been done. The length of the transaction or the longevity or the antiqueness of that transaction is not something that will be available to you as far as a defense is concerned, except to the extent that the law provides for grandfathering in certain circumstances, right, for investments made up to 31st of March 2017. But other than that, if this is not a case of investments, it's a case of some other transaction, then the longevity of that transaction or the history or the antiqueness of that transaction will not be a defense. GAR would be applied to any step or any part or even the whole of the arrangement. GAR can be used in addition to or in conjunction with any anti-avoidance provision. So SAR and GAR can coexist. And onus of proving that an arrangement is an impermissible avoidance arrangement is on the department. So thankfully, at least it is not the taxpayer who will have to, as a matter of normal course, substantiate that his arrangement is impermissible. It will be the department who will have to allege it. That allegation has to be formed on certain reasonable basis, and the taxpayer's role is then to defend what he has done. Now, coming to some of these consequences of GAR, and we will take examples of each of these. So one of the consequences of GAR is that a step or a part of a transaction or even the whole transaction can be disregarded. So for example, if say there is a US entity which has a Mauritius subsidiary, and I'm talking about, or let's talk about a Netherlands subsidiary today. The US entity actually wants to sell the shares of an Indian company to, say, a Canadian resident. Now, if the US entity were to sell those shares, then there would be capital gains in India. As we all know, that the US treaty provides for taxation of capital gains in consonance with domestic law. And therefore, the gift of shares to a Netherlands entity and the consequent transfer to another non-resident would result in no tax being paid in India, and that transaction of gift could be taken up under GAR, right? Because the grandfathering presumably would be till the gift happened to the non-resident entity, to the Netherlands entity. In the hands of the Netherlands entity, there would be no grandfathering because it acquired the shares now in 2021. Now, combining or recharacterizing any steps, again, if you form a partnership firm, contribute an asset, then have a retirement of partners, purely a domestic law transaction, but certainly can be looked at as far as GAR is concerned. Treat the arrangement as if it was not entered into, ignoring of the setting up of an SPV, so taxing the owner of the SPV, the shareholder of the SPV directly rather than taxing the entity itself. Disregard or treat any accommodating party as one and the same. Say if you route a loan through a bank in the tax-friendly jurisdiction, the bank would be required, routed as an accommodating party. So many times it so happens that there would be a related concern in some foreign jurisdiction who would place a fixed deposit with a bank in, say, its home jurisdiction, and the branch of that particular bank in a tax-friendly jurisdiction would then lend the money to the Indian entity so as to avail of a lower withholding tax rate. That potentially could come under GAR, and you would treat the arrangement with the bank as if it was not entered into, and you would say that the borrowing came straight from the related party located in a non-tax friendly jurisdiction. Disregard or treat any of, deeming connected person to be one and the same. So if you split the investment into two entities, as we all know, there are certain treaties in Europe like Spain, France, where if the Spanish or the French entity holds less than 10%, even Netherlands, if it holds less than 10% of the share capital of an Indian entity and those are sold, then there is no tax to be paid in India, because in those treaties, in those times, portfolio investment activity was to be encouraged, and therefore this clause is present. Now, if say somebody holds 20%, he transfers 10%, he wants to sell 10%, he transfers the 10% to an entity, a group entity in either Spain or France, and the Spanish or the French entity sells it, then that would be a case of deeming connected persons to be one and the same. Reallocate expense or relief. If you have back-ended revenue under a contract, which should otherwise have been spread over the life of the contract, then that could be a case of reallocate income or expenses. or treat the place of residence, situs of an asset or a transaction at a different place. Again, your classic cases of what is going on today in the special bench as far as Cyprus is concerned, where Cypriot entities are, sought to be disregarded and treaty benefits denied, and disregard or look through any corporate structure is lifting of the corporate way. These consequences, as we all know, are inclusive, and can one or more of these consequences can be levied together in a manner which is deemed to be appropriate. Of course, there is a threshold for applicability of GAR, and there is Rule 10U of the Income Tax Rules 1962, where if the arrangement does not result in a tax benefit of more than 3 crore rupees, then GAR will not apply. And also there is a grandfathering, as we saw, of investments, any income from transfer of investments made before 1st of April 2017 would be, not subject to GAR. There's an example that I have put on how the 3 crore is to be looked at. We will not be delve into this. CBDT clarifications very, very quickly. Will GAR be invoked if SAR applies? CBDT says both can coexist. GAR will not interfere with the right of a taxpayer to deduct or choose the method of implementing a transaction. So if you have a method of implementing a transaction which is, two ways can be, the transaction can be done in two ways. So for example, you can either do a dividend or you can do a buyback. Of course, now under, because you have a buyback tax, maybe if you have a shareholder which is a bona fide resident of a low tax jurisdiction, then a dividend solution would be better. At one point in time, we all know that Cognizant, before buyback tax was introduced, adopted buyback. And, the department has sought to question that buyback. But I would think that in a case where it is substantiated by commercial reason, an alternative either of going in for dividend or going in for buyback will not be questioned under GAR. The reason is that there are two bona fide ways of doing certain things, and if there are commercial reasons, there's no issue of GAR. Now, will GAR apply if an AR is already there? And this is really, in a way, historical. And we will see that there are not too many cases where there have been something blessed. Of course, in AB Mauritius's case, there has been something which is blessed for the holding company that we will come to. But basically now, this is for GAR, the AR. Same case for any arrangement of merger, etc., where the NCLT or the High Court has dealt with a particular, tax implications, then GAR will not apply, because there's already a court or a higher authority of a tribunal which has actually adequately considered the tax implications. And de minimis threshold is to be assessment year specific, and with respect to the arrangement or any part of that arrangement, it cannot be read in respect of a single taxpayer only. All the taxpayers connected, the benefit to them will have to be looked at, and the tax benefit will have to be looked at. And only the tax benefit in Indian jurisdictions will be considered. A tax benefit in a foreign jurisdiction will not be considered. Now, with that backdrop, again, domestic law legislation was one thing, but treaties did not have such exhaustive tax avoidance or anti-tax avoidance measures. And therefore, a need was felt that when there are cross-border arrangements, then you need to have the treaties also to have sufficient meat to be able to counter those tax avoidance arrangements, which is why in the OECD and the G20 countries set up a group to basically formulate this multilateral instrument. Multilateral instrument, as we know, is based on the concept of substance over form, and there are different action plans of the OECD which deal with this multilateral instrument, and let's kind of look at very clearly. So a multilateral instrument is an instrument which implements the tax treaty related measures of the BEPS action plan, and the treaties which will stand modified to incorporate the BEPS related measures into the MLI are called covered tax agreements or CTAs. And an existing tax treaty will be covered or will be considered as a CTA if both the countries to the bilateral tax treaty have signed the MLI. Both the countries have ratified the MLI under domestic law procedures, and both the countries have deposited the ratification arrangement with the OECD. And along with the ratified copy of the MLI with reservations, you can have a reservation, and India has a reservation on many of the MLI articles. Both the countries toward bilateral tax treaty have listed each other in their respective list of treaties which are to be modified by the MLI and submitted to the OECD. And once the MLI is effective for the contracting party, the existing tax treaty will have to be read in accordance with the MLI. So the Indian government has, of course, deposited the ratified copy on 25th June 2019. The Indian government has listed all of its tax treaties except the tax treaty with China as covered tax agreements. And as far as India is concerned, the MLI has already entered into force from 1st October 2019 and is applicable from assessment year 21-22, right? Is applicable from assessment year 21-22. Again, this is a little bit of dated information, but let me give you the correct information. Today, there are 94 countries or 94 treaty partners who have signed the MLI as far as India is concerned. And 64 of them have already deposited the ratified copy of the MLI instrument. So the MLI is effective for most of the treaty partners. The countries listed here, which are the primary trade partners or major trade partners of India, which are Australia, France, Netherlands, Japan, Singapore, UK, etc., already are, the treaties with those countries are already subject to the MLI. So there are, as I said, 64 countries who have. One part of the MLI is the principal purpose test, and let us look at this instance, and that will give us context of what this principal purpose test is. So a lawyer cabled his client overseas. He said, "Your mother-in-law has passed away in her sleep. Shall we order burial, embalming, or cremation?" And the gentleman in question says, "Take no chances, order all three." So this is how I believe the principal purpose test has been devised. If we see, there is a three-pronged approach to how BEPS Section 6 looks at prevention of treaty abuse. One is obviously the preamble to the MLI and the treaty. So as we saw in Azadi Bachao Andolan, one of the objects of entering into the treaty, as was mentioned in the treaty, was to promote bilateral trade. And again, there was no mention of not allowing double non-taxation. So one of the arguments that the petitioner, Mr. Jha, in the Azadi Bachao case took was that the income that is being not taxed in India by virtue of capital gains is also not taxed in Mauritius, because Mauritius, under its domestic law, does not tax capital gains at all. And therefore, the money which is upstreamed from Mauritius back into any other country, escapes taxes completely, and therefore it results in something called double non-taxation. And very clearly, therefore, the MLI, recorded this sort of, arrangement and said that, look, we do not want to encourage double non-taxation, and therefore the title and the preamble now contains a clear statement that the contracting states intend to avoid creating opportunities for double non-taxation or reducing taxation through tax avoidance or evasion, including through treaty shopping. So very clearly, there is a frowning upon on creating situations of double non-taxation or even reduced taxation in the country of residence of a particular taxpayer. And the emphasis is on looking at treaty shopping arrangements and trying to curb treaty shopping arrangements unless there is a proper substance of the particular taxpayer in the jurisdiction where he claims to be resident, the treaty benefit will be denied. Coupled with that, you have the principal purpose test rule, which is again a general anti-abuse rule based on the principal purposes of a transaction. And it says that one of the principal purposes of the transaction is to take benefit of a particular tax treaty, then the if that is the one of the principal purposes is to take advantage of a particular tax treaty, then obviously the treaty benefit will be denied because such arrangements cannot be permitted. With that, there is a third prong, which is a limitation of benefit rule, which are based on objective criteria such that as legal nature, ownership. So if we look at the US treaty, again, there's a very comprehensive limitation of benefit rules, which again to some extent has now been replicated in the new Mauritius and the Singapore tax treaties as they have been amended. But the US tax treaty basically says either you are owned by an individual of the US and you have an active business in that particular contracting state where you are, and then you're not a holding company, or then you are listed in that particular jurisdiction, then you're fine and we will allow the treaty benefit. Otherwise, there is no question of giving you treaty benefit. So the concept of substance over form now has been enshrined in 3 different pillars of Action Plan 6. One is obviously the preamble, where the intent and the purpose of entering into a treaty has been very, very clearly stated. 2 is that principal purpose test, and the third part is a limitation of benefit article. Now, the preamble is a minimum standard, and that language has to be put into each and every treaty where the countries have signed the MLI. The second part is whether you can take only the PPT or you can take the PPT plus the LOB, or you have a very detailed LOB with mutually agreed anti-abuse provisions. So mostly India in its own treaties have said that we would like to adopt the PPT plus a simplified LOB clause for the purposes of all our treaties which we have notified under the MLI. And we will look at what the PPT very clearly provides. Now, as far as the preamble is concerned, the preamble reads like this: recognizing that governments lose substantial corporate tax revenue because of aggressive international tax planning, that is the effect of artificially shifting profits to locations where they are subject to double non-taxation or reduced taxation. So it targets aggressive international tax planning. It also notes the need to ensure that existing arrangements are interpreted to eliminate double taxation without creating opportunities of double non-taxation or reduced taxation. And as we saw, including through treaty shopping arrangements. So it targets treaty shopping arrangements. And India's statement in the explanatory memorandum to the Finance Bill 2020, where ultimately it recognized and it said that we have now entered into the MLI. It very clearly said that the MLI will modify India's DTAAs to curb revenue loss through treaty abuse by ensuring that the profits are taxed where substantial economic activities generating profits are to be carried out. So the concept is, again, unless you have economic activities in a particular jurisdiction, you will not be able to access the treaty of that particular jurisdiction. Now, if we see what the MLI provides, it says that notwithstanding any provisions of a covered tax agreement, this is the language of the PPT clause, right? notwithstanding any provisions of a covered tax agreement, a benefit under the covered tax agreement shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all facts and circumstances, that obtaining that tax benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in the benefit of that treaty. Now, 2 or 3 expressions are very, very important. That it has to result in a benefit. That benefit will not be granted in respect of an item of income if it is reasonable to conclude, and we'll come to what is reasonable, that obtaining this benefit was one of the principal purposes of an arrangement. And we'll come to what is the principal purpose and how do you look at a principal purpose. That principal purpose has to be of any arrangement or any transaction, and the principal has to result directly or indirectly into that tax benefit. We call this the reasonable purpose test. There is an exception to this reasonable purpose test, that unless it is established, and mind you, there is reasonable to conclude at the top, and here it is established. So the onus in this exception is where is higher. That granting of the benefit in these circumstances would be in accordance with the object and the purpose of the relevant provisions. So if the treaty very clearly provides that the benefit has been consciously granted by the 2 countries, this PPT or the BEPS Action 6 also recognizes the principle that 2 countries can certainly enter into a treaty which is aimed at providing a benefit, but that has to be clearly mentioned in the treaty. Now, if that is mentioned in the treaty, there should be no problem. GAR has no such, object and purpose test behind it. If the main purpose is the claiming of a tax benefit, then GAR will apply. So we will look at interplay. But basically, again, if we look at what is a tax benefit, really, it's a non-obstantive provision with a mandate of the denial of treaty benefit. Only the treaty benefit is the consequence. There is no other consequence like in GAR, where you have combining of the transaction, disregarding of a particular arrangement, disregarding a particular party to that arrangement. All of that is not there. It extends to direct or indirect benefit also. So if there is an indirect tax benefit also, that also will need to be looked at. And it covers all limitations or taxation imposed in the country of source, as well as treaty benefit obtained in the country of residence. So you have to look at treaty benefit in or tax benefit in both the countries, the source country as well as the residence country. So this would have no implications as far as any domestic law tax concessions are concerned. For example, we have a lower rate of interest on certain borrowings under Section 194 LD or LC. Those lower rates or those tax concessions would not be looked at when we look at the principal purpose test. Now, when we look at the first part, which is the reasonable purpose test, we will have to look at this test with a very granular approach. That is, we will have to evaluate the purpose with regard to each arrangement, each stream of income, not qua the entity as a whole. As somewhere in GAR, again, you may have to look at the entity as a whole, whereas here you will have to look at each source of income, each arrangement that results into that source of income, and determine the principal purpose or one of the principal purposes of that arrangement. Applies to an arrangement if it's one of the principal purpose is to claim benefit, as we saw. Obtaining treaty benefit need not be the sole or the dominant purpose. What is principal, again, is a matter of, it's a matter of looking at the overall picture. There is no scientific definition of the term principal. Principal is in a way the same as main. Principal is the same as dominant. So particular arrangement can have more than one equally dominant purposes in terms of, claiming a tax benefit as well as coming in through a particular country. So for example, let's take a case where you have a Mauritius holding company which holds investments in other jurisdictions in Asia. I am a US resident. I have a Mauritius SPV, which holds investments in other Asian jurisdictions as well, right? I make an Indian investment through that particular SPV. Now, I have two purposes in mind. One is to claim a tax benefit as far as India is concerned. The other is to consolidate my holdings in Asia into one particular holding entity. As far as GAR is concerned, the main purpose could be that I want to hold all my investments in Asia into one particular entity, and therefore I would be able to probably, and again, this is untested today, but I would be able to put in a defense to say that, look, I have been holding other investments in Asia through this particular Mauritian entity, and therefore I wanted to consolidate all my holdings in Asia into one particular entity, and therefore I have formed this, or I have made the Indian investment through this Mauritius entity. And there, the dominant or the main purpose would be to hold all the investments into a particular single holding company. Whereas as far as the PPT is concerned, there could be an allegation to say that you had two dominant purposes. One dominant purpose being what you are saying, the other dominant purpose being taking of a tax benefit. And there you will have to prove by facts and circumstances that tax benefit was not one of the dominant purposes. It was one of the incidental, items that I saw. That yes, I had all the entities in Asia under this particular holding company. It made sense because I did not have to employ other people. It made sense that I did not have to have another company where I would have had to, incorporate the company, maintain accounts, maintain separate books, engage administrators, have those books of account audited, have separate board meetings, record those separate board meeting minutes. All of those issues I don't have to look at. Therefore, tax benefit is not one of my main purposes or one of my principal purposes. My principal purpose was to have simplicity of holding, and therefore I would want to say that this was not one of my principal purposes. But again, this will have to be demonstrated through your own conduct, your own utterances, and your own writings. And this will be very important because oral, evidence is really of no meaning as far as the Indian tax authorities or the Indian courts are concerned. You may say whatever you want to, but it is what is called ipse dixit, which is, something that you have said, right? And it has only limited evidentiary value. However, if your documentation at the time of setup, at the time of making of the investment, right, very clearly provide that you did not consider tax benefit as the dominant purpose or one of the dominant purposes, then you should be able to, pass the principal purpose test. The purpose is, as we said, an inanimate exercise. Ultimately, it's a question of fact. It requires objective analysis of the relevant facts and circumstances, as we just saw in our example. And of course, it has to be reasonable to conclude. And we saw that it has to be reasonable to conclude that claiming of treaty benefit was not one of the principal purposes. Now, what do you need to look at when you look at reasonable to conclude? It is something having sound judgment. It is fair. It is logical. It is not unreasonable. Alternative views need to be examined very, very objectively. So if I have two jurisdictions where I hold Asian investments, to take our example and just change the facts a little bit. If I have, say, a jurisdiction A, which has a favorable tax treaty with India, I have a jurisdiction B, which does not have a favorable tax treaty with India, and I choose jurisdiction A, then I will also have to, in a way, demonstrate to the Indian tax authorities as to why not jurisdiction B. So it's very important to not only look at the why, but also look at why not of a particular alternative that is available to you. All evidence, of course, must be weighed, and looking merely at the effect is not sufficient, but the purpose has to be, looked at very, very seriously. The tax benefit purpose is not to be assumed lightly at all. And as I mentioned earlier, a self-assertion by the taxpayer is not sufficient and is not conclusive evidence. So one will have to say essentially that is your arrangement capable of being justified without taking into account the tax benefit element at all. Leave the tax benefit element aside, look at why that particular arrangement has been carried out. If you have a why which is strong on the commercial side, as we explained, I want a simple jurisdiction where the compliance is not very onerous, where the cost of maintaining holdings is not very onerous, and I have other holdings in that particular jurisdiction which are non-Indian, and I make the Indian investment to that jurisdiction, then that is something which is disregarding the tax benefit altogether. The fact that I have a tax benefit will always be, something which will be at the back of everybody's mind, but that is not the dominant purpose for entering into the transaction. Now, object and purpose, again, even if the tax benefit is one of the principal purposes, PPT carves out that if it is in accordance with the objects and purpose of the relevant provisions of the treaty, then the PPT will not apply. And it has to be established, as we saw, that the onus is to establish the applicability of carve-out, and it is a much higher threshold than a reasonableness test. It is a conclusive test. So a reasonable purpose test is a question of fact, but an object and purpose test is a question of law. And basically it means that it has been very clearly written down that the object of this arrangement is to be allowed. As we saw in the old amended, unamended, or the old treaty, Mauritius Treaty, before its amendment, where the Supreme Court very clearly said that one of the objects is also to improve and to further economic relations between the two countries. India is a country which needs foreign investment, and that is documented as far as the treaty is concerned. If that documentation happens, then you will fall into the object and purpose test, and you will be able to go out of the PPT. Sadly, I don't think any of India's newer treaties have something like this, right? But it's just that this carve-out has been left out by the OECD, rightly so, because we do not know, circumstances may change. Today we have the pandemic. Hopefully we are out of the worst effect of those pandemic, but God forbid if something were to happen where the effect was to last longer, then I would think that the whole scenario globally may change as far as trade and commerce is concerned. So the carve out has to be there, rightly so. And again, I think, it's based on quantitative criteria versus other distributive rules versus general. This we've already covered. Really, some of the examples that are given in the OECD commentary, we will very quickly look at. And I know we have only 20 minutes, but we'll try and speed it up. So if there is, this provision is really intended to ensure that in respect of bona fide exchange of goods or service and movements of capital and persons, right, the exception is allowed. And the commentary further goes on to say that it is not necessary to find conclusive proof that the intent of a person concerned with the arrangement of transactions, but it must be reasonable to conclude after an objective analysis of the relevant facts and circumstances that one of the principal purposes of the arrangement was to claim the tax benefit of the transaction. Where, however, an arrangement can only be reasonably explained by a benefit that arises under a treaty, it may be concluded that one of the principal purposes of the arrangement was to obtain that tax benefit. And where an arrangement is inextricably linked to a core commercial activity, it is unlikely that the principal purpose would be considered to obtain a tax benefit. So there are certain averments here in the OECD commentary where some observations will help in particular situations. There are certain examples also given, right? We will not go into this for want of time, but basically, again, we will look at some examples, or we'll straight go to, I think, the uh, commercial factors for SPV formation as far as Vodafone is concerned. Now, in Vodafone, the judges very clearly said that these could be the factors relevant for forming an SPV in a tax-friendly jurisdiction, which would be better corporate governance, hedging business risk. For example, high-risk assets may be parked in a separate company so as to avoid technical and legal risk to the group, and political risk, protection from legal liabilities, mobility of the investment. You can sell it even at the SPV level. Enable creditors to lend against a specified investment without worrying about any collateral liability that the company may have had at the company level. Facilitate an exit route and providing specialization. So these will all be factors which will help us to evaluate the choice of a holding jurisdiction. Availability of skilled multilingual workforce and directors with knowledge of regional business practices and applicable regulations. Membership of a regional grouping. So, for example, FATF, we know that Mauritius was in the FATF grey list. Now it has come out. Extensive tax treaty network, reliable regulatory and legal framework, business-friendly environment, developed international trade and financial markets, political stability, sophisticated banking industry, lender and investor familiarity, lower operating costs, and difficulties or limitations of a home jurisdiction which are ironed out in the SPV jurisdiction. So these will be some of the factors that we will need to take into account when we look at an SPV type structure. Now, step by step, if we evaluate the PPT, first we will have to identify what the arrangement is and what the related benefit is under that particular tax treaty. Then we will have to compare the arrangement with the realistic counterfactuals, as we were looking at why not a particular different arrangement. Compare that with the counterfactuals, agree that this arrangement was the best arrangement in the particular set of circumstances. Then look at the scale of treaty benefit and weigh that with the evidence of non-tax business purpose to substantiate that the arrangement is not to obtain treaty benefit. So again, what is the quantum of the benefit? How long is it going to continue? Will have to be weighed with what is the non-tax business purpose? How long will your non-tax advantage actually continue? All of that will have to be looked at. And then after we evaluate that, we have to take a final step to examine whether obtaining treaty benefit is one of the principal purposes or not. And if the answer is yes, then we will have to look at whether the obtaining of the treaty benefit is with the object and purpose of the treaty. If the answer to that is yes, PPT is satisfied and generally, therefore, treaty benefit will be granted. If not, treaty benefit will not be granted. So this is really a flowchart of how we would want to evaluate the PPT. And it's very important to take this in a step-by-step manner so that we are able to very clearly demonstrate to the tax office. Ultimately, all of this has to be a question of being able to demonstrate as to how you have arrived at. And many people actually come and ask us for opinions on whether we satisfy this PPT or not. And I've seen that when you ask them certain very difficult questions, the answer is either, oh, but this is so old that we don't have anything. Or some people say, but we didn't even evaluate these kind of things because at that time, we had a particular jurisdiction which gave us treaty benefit. In which case, then it becomes very difficult for any consultant to be able to give a sign off to say that this arrangement is kosher from a PPT perspective. And the challenge will always be that the devil is always in the fine print. So when we look at a particular arrangement, you will also have to look at what is not written, right? Okay, what is written is fine, but what is not written also assumes importance. So when minutes are written or resolutions are written or emails are exchanged, it will have to be very, very carefully evaluated in terms of, is there any internal correspondence which also seems to suggest that this arrangement was only entered into with the purpose of claiming tax benefit? Because you cannot rule out the possibility of the tax authorities having knowledge of all your internal emails as well. There could be a survey. Even if there could not be a survey, once you write an opinion, you will have to write it in a fashion that the tax authorities know everything that exists. And from that perspective, one will have to be very careful when one signs off on the applicability of the PPT. So as far as PPT is concerned, again, one would think that, as that it's a tool in the hands of the tax department, and that tool has every reason to be misused. And in the words of, the noted Queen's Counsel, Philip Baker, there is every reason to fear that once the MLI is in force and a large number of countries, including ones with tax authorities that do not have a reputation of predictable interpretation of tax treaties, begin to apply the PPT, this will undermine the whole system of tax treaty benefits. Put simply, no taxpayer who has given any consideration to the impact of a tax treaty on its transactions or arrangement will be able to rely with any certainty on obtaining the benefits of the tax treaty. That may be probably the situation, at least as far as the initial years of application of the PPT is concerned. As we ourselves, when we write opinions, we struggle with getting facts. I'm sure that the tax authorities will equally struggle with getting facts. And the threshold of facts that they will need to come to a satisfactory conclusion is, I'm sure, higher than what we as practitioners or what we as consultant or what we as legal counsel would be requiring to give a sign off to a client. And therefore, it is expected that this will have some sort of challenge in terms of the implementation. We will look at litigation ensuing at least for the first few years till a predictable interpretation settles down. Of course, given the fact that now we are moving to a global minimum rate of taxation under Pillar 2, and if everything happens, in that direction, one may not need to look at some of these situations. And if there's a global minimum tax, everybody should be probably happy. But again, those days are far. I would think that, the zeal of a tax officer and the zeal of an assessee to both, the zeal of an assessee to minimize his tax liability, and equally the zeal of a tax officer to try and see that the revenue's interest is kept alive, are always going to play with each other when we look at the PPT and interpret the PPT. So let's now look at the interplay of PPT and GAR, and let us look at certain key differences. And I know that we are probably running short of time. We'll take 5 or 10 more minutes extra, but we'll try and finish the presentation. So really, the threshold is not the same. Okay, two views. The threshold is not the same as far as main purpose of GAR and the PPT is concerned. So they say that in India, a main purpose threshold was introduced post significant debate and to allay the fear of wider canvas of one of the main purposes test. And therefore, the threshold under GAR is far more restricted as compared to the threshold under PPT. Right? UK HMRC GAR says that one of the main purpose is wide to cover transactions implemented for commercial reasons also, and also to have a substantial tax advantage. UN commentary, the main purpose test may be interpreted restrictively in favor of taxpayers and to render the provision ineffective. And UN handbook suggests that one of the main purpose tests is relatively easy to satisfy than a main purpose test. Now, Again, the other view is that the threshold is practically the same, where the dictionary of main and principal suggests that both refer to something chief, primary, or most important. OECD PPT gives flavor that PPT applies only when treaty benefit is the main reason for the transaction. Both require objective analysis of facts and circumstances, and both factor the object and purpose. And para 18.1 of the 2017 OECD commentary states that to trigger a PPT, obtaining a treaty benefit should be a principal consideration behind entering into any commercial transaction. In my view, frankly, there is very little difference between GAR and PPT, if you ask me. Because one of the main purposes, it doesn't matter whether there is a singular main purpose or there are one or two main purposes. I would believe main by itself or principle by itself implies a singularity in term. And therefore, even if you call the OECD language to say that one of the principal purposes is mentioned, and therefore you can have more than one principal purpose, my view is that ultimately it will have to be the test of you looking at what is the arrangement without the element of treaty benefit or without the element of tax benefit. If you are able to, pass the litmus test or the smell test, we all know what is right and what is not quite right. If we are able to look at an arrangement and put our hand on our heart and say that if I disregard the treaty benefit also, this is fine, then I would believe that the benefit or the one of the principal purpose and the main purpose should somewhere coincide. Again, of course, you would have to, as far as GAR is concerned, also in addition to the main purpose, look at the secondary benefits. We saw secondary test, sorry, why am I using the word benefits? Secondary test, where, is it not at arm's length? Is it lacking commercial substance? Is it resulting in misuse or abuse? These are additional tests to be satisfied under GAR, in addition to you failing the main purpose test. So if the main purpose test is ultimately to be determined in favor of the fact that the main purpose was to claim a tax benefit, you would still have to satisfy one of the 4 additional tests that GAR provides. Whereas, as far as PPT is concerned, the only other thing that you need to look at is object and purpose of the treaty. So PPT, in that sense, as far as the additional tests are concerned, those are absent. And that way, PPT may be a better, or more restrictive provision as compared to GAR. But I would think that from whatever arrangements I have seen, I have practically had very little reason to go to one of the additional tests. So you either figure out, whether something satisfies the main purpose test or not. If it does not satisfy the main purpose test, my answer to one of the 4 tests would be you would actually fall in one of those 4 links, right? That's practical experience. Practically, you will not see a situation where your main purpose would be to claim a tax benefit, but you don't fall in one of the 4 additional limbs of GAR. But again, of course, we cannot rule out that possibility. I'm just saying that today, as far as my limited experience is concerned, I have not seen them. Consequences are wider as far as GAR is concerned. The only consequence of the PPT, as we saw, is the denial of treaty benefit. Onus, the primary onus to call an arrangement an impermissible avoidance arrangement is that of the tax authorities here. As far as PPT is also concerned, I would believe that, again, the same onus applies. The rebuttal for carve out, is something that the assessee will have to argue. There is an approving panel for GAR where there has to be a reference made, whereas for PPT, there is no approving panel. It will have to be determined by the assessing officer, and then ultimately it will, I would believe, go into a map type of proceeding. as far as I see it. There's no grandfathering as far as PPT is concerned, whereas GAR has one, and there's no de minimis threshold of 3 crores as far as PPT is concerned. So really, that's the interplay between GAR. As far as treaty benefit is concerned, PPT has to be fulfilled. If an arrangement or a transaction is tainted as far as PPT is concerned, treaty benefit will be denied. GAR may not therefore be necessary for denying the treaty benefit. You may still recharacterize the transaction under GAR, but that would be a separate proceeding as far as GAR is concerned. If an arrangement passes the PPT test, GAR in all likelihood will get fulfilled. Main purpose that GAR, if at all, is, I would believe, a higher threshold as we saw. And 97(1)(c) test likely to be passed as location and residences for substantial or commercial purposes. As I was seeing in practical experiences, once you see whether the main purpose is of claiming of a tax benefit or not, then if the main purpose is not to claim tax benefit, then you will not need to go into the additional conditions. If you fail the main purpose, then you will definitely, in all likelihood, at least my experience suggests, fall into the other provisions. So we will very quickly look at 1 or 2 case studies, and then we will stop. As far as dividend, etc. is concerned, let's look at these case studies.
We have only 5 minutes, sorry to disturb in between, because the other speaker has also come. And
sure. Yes, Rakesh, we'll finish in 5 minutes.
Thank you.
We'll try and cover one of the case studies and then we will stop. The other case studies are pretty much self-explanatory.
Thank you, sir.
So you have a case where a US company is a listed operating entity. A US company has established regional headquarters company in Netherlands for undertaking foreign investment into various EU and Asia Pacific jurisdictions. The Netherlands company 1 in our chart has significant substance, managerial staff, relevant infrastructure for supporting its arrangements. Netherlands company number 2 was established as a JV company, and Netherlands company earns dividend and interest on CCDs, etc. And NL company 2 has a valid TRC and claims to be the beneficial owner. And India-Netherlands tax treaty, of course, is now modified by the MLI. Okay, and therefore the preamble and the PPT get inserted. Now, assuming Netherlands company 1 has substance, while Netherlands company holds only ICO, does PPT analysis differ? And the question is therefore that if you disregard Netherlands company 2, which is the JV company for whatever reason, ultimately, where will you roll up to? Will you roll up to Netherlands company 1? In which case, there is really no difference, because if you're saying I will disregard Netherlands company 2, then I go back to Netherlands company 1, and Netherlands company 1 has the requisite substance, it has everything. So therefore, do I look at that, or do I look at straight away up to the US and say, no, US is the beneficial owner, and therefore I will look at US, right? And question really, therefore, is that what is the impact of the PPT? Now, the impact of the PPT will be that the treaty benefit as far as Netherlands company 2 will be denied. And you will not need to roll up to either the US company or to the Netherlands company 1, right? And, again, I have listed out, both the taxpayers as well as the tax authorities' contentions, which we can use. There are, again, case studies in respect of capital gains where views are expressed, and also debt versus equity. And then we've dealt with some of these cases of AB Mauritius, etc. With that, let me stop sharing and thank the WIRC for a very, the opportunity for me to be able to, deal with you. Thank you very much. And, look forward to seeing you again soon. Thank you. Rakeshji, I cannot, bring on my video back. If you could permit me that would be.
Rakesh, you're on mute.
Yeah, I think it should be. I see Mishraji, can you just
Mishraji, video, please.
Yeah. Put Anish sir's video back. Thank you, Anish sir, for this presentation and also completing it on time. We will be sharing the slides with the participants, and if you have any questions, do give it to WRC. We will pass it on to Anish sir.
Yeah, I will.
respond.
I think. Yeah, I'm sorry that I wasn't able to complete the questions, but if you send me the questions in writing, I will reply to them.
Right. May I request Monarch to give the hearty vote of thanks?
Thank you, Rakesh ji. On behalf, am I audible, sir?
Yeah.
Yes, please.
Okay. Yeah. So on behalf of WRC, sir, I take this opportunity to propose vote of thanks to Anish, sir. I think there would not be any enough words enough to describe the way you have been making chartered accountants and students of this profession learn the new concepts which evolves, be it domestic tax and international tax from the very basic level, sir. Sir, I proudly say that I am one such student of such opportunistic webinars from tech stalwarts and tech wizards like you, and it has helped me entered in the field of international tax and grow myself. So we always look forward to you when new provisions or concepts evolve to understand how it will sail through. It always feels like a parent guiding to their son or their children. Sir, I wholeheartedly thank you for sparing your valuable time and teaching us such difficult and draconian provisions of domestic car and PPT. On behalf of WRC and everyone present here, I once again thank you for your valuable contributions. Thank you.
Thank
you very much. Thank you very
Anish,
much.
sir. On the request of many participants, let's take a 5 minutes nature break. Our next speaker is already joined. Looking forward to hear from CA Hema Lohiya soon. So let's take this 5-minute nature break.
Thank you.
Hello, Rakesh sir. Hello. Hema madam. Hello.
I think Rakesh sir break पे गए होंगे sir.
हाँ सर, क्या बोले सर आपने? मैडम आपका पीपीटी शेयर करिए। राकेश सर।
हेलो।
हाँ राकेश सर।
हाँ बोलो।
सर हेमा मैडम का इंट्रोडक्शन करना है।
सॉरी,
सर लिख के सकते हैं सर। नेक्स्ट स्पीकर हेमा मैडम।
एक मिनिट। हाँ बोलो वैभव। हाँ झालं झालं। हाँ 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 झालं 5 मिनिट करेक्ट.
हेलो हेमा मैडम।
हाँ वैभव।
हाँ
आपका पीपीटी शेयर करिए।
ओके, I'll email you.
करिए मैम।
Is it uploaded? Not yet, Hema.
Should I share it or?
Yeah. You'll have to share it. No? Upload it.
Yeah, I'll do that.
While Hema is uploading it, Vaibhav, can we start?
सर मैडम का पीपीटी मैडम आपका कैमरा ऑन करिए ना मैम।
Yeah.
हाँ
Yes.
अभी तो आ गया। ओके
Okay,
आपका
let's
कैमरा ऑन
start.
करिए मैडम।
Yeah. Give me a second.
Welcome, CA Hema. Should we start, Vaibhav?
Yes sir. Yes sir.
Okay. So friends, welcome back. We are now starting the second session. As we saw, Anish sir did mention about the substance test, and then he went to Vodafone and similar cases where investment was the primary criteria. Now we are getting into a much bigger challenge, and that challenge is of the mobility of people. And this pandemic has actually increased that risk to a great extent, because many places now people are coming on ground and taking decisions from different parts of the world. So essentially, where do you satisfy the permanent establishment matters, or where do you satisfy the substance test, or where the profit should be actually taxed, is going to be a big issue in this global mobility and the networking that is happening. For that, now people functions, place of effective management are all going to be very, very aggressively looked upon. For this, we have our new speaker, the fresh speaker that we have for this session, CA Hema Lohiya. Although I said a new speaker, she has been with Institute for long and has been a regular speaker at our forums. Prior to giving her introduction, may I inform all the participants that CA Hema Lohiya has been the architect in framing this whole course. She has taken, all the pains to decide the topics, decide the faculties, interact with them, ensure that there is a flow, and even the timing has been, framed by her under the guidance of course, Mr. C.A. Gupta, who has also been always helping the institute. So thank you so much, Hema ma'am, for structuring this particular course, and we look forward for many more such structured programs from you.
Thanks, Rakesh.
Coming to introduction of CA Hema, she, as we told, as I informed, she is a regular speaker not only at ICI but at various forums. Although she looks quite young, she has more than 20 years of experience in the field of international tax. She has been advising clients on cross-border transactions, permanent establishments, investments in India, and even some of the most complex business transactions. She has authored several articles and is a welcome and fished after speaker on the various tax forums. So a warm welcome to CA Hema. Please share your thoughts on this most complex topic of global mobility linked with your permanent establishment issues. The floor is yours.
Thanks. Thank you, Rakesh. Is the presentation visible?
Yeah, maybe you may have to put it on desktop mode, the full mode. Yeah.
Okay. So as Rakesh mentioned, with the onset of pandemic, lockdowns,
हेलो हेमा मैडम
yeah,
मैडम इसको है ना अपना डिस्प्ले सेटिंग है ना वहाँ पे जाके इसको स्लाइड शो पे करिए मैम क्योंकि आपका दोनों स्क्रीन दिख रहा है और दोनों दिख रहा है हाँ अब इस फुल स्लाइड करिए स्लाइड शो करिए
oh, okay. I
हाँ नहीं आप एक काम करिए ना मैम इस पे जाइए ना ऊपर देखिए डिस्प्ले सेटिंग दिख रहा है आपको ऊपर एकदम
On the top line, display setting, just arrow on that.
आपका एरो उसके बाद
Just next to that, next to that, display setting. Yeah, next.
उसमें नहीं होगा मैम बाजू वाले जो तीन ऑप्शन है ना तीन में बीच वाला जो ऑप्शन है ना उस पे जाइए डिस्प्ले सेटिंग ऊपर
I cannot see display settings.
Vaibhav, can you upload it from your end if you have the slide deck?
मैडम आपके लैपटॉप
Okay, give me a minute. I can just send you this.
Now, while Hema ma'am is setting up the presentation,
Okay.
one more task that may be there is like in this particular session, there are participants, as we discussed last week, from different countries, including Australia and Dubai. The question may come up that the revenue that institute makes, whether needs to be attributed to the participants who are actually paying also. Maybe question, or if there are speakers now coming up at institute from different places, how do you deal with those scenarios? So these are the separate questions, Hema ma'am, while you're presenting it, that everyone has in their mind.
Sure, Rakesh. Maybe if time permitting, what I can do is I can present for 85 minutes, and then maybe we'll keep last 5 or 10 minutes for the Q&A. So maybe while Vaibhav is presenting the deck, I will start, not to waste the time. So as an introduction, with the onset of pandemic, lockdowns and restrictions have become new norm. And this has actually created a new population of international mobile employees. Now, people may be traveling, let's say in India, for a variety of reasons. So some may have chosen to come to India and work, maybe to stay with their friends and families. There could be a population who may have got stranded in India. And there could also be a population who may want to explore working from an international destination. Also today, many employers are encouraging work from anywhere policies to incentivize and support the talent. Also, what we observe is, if there are a project, let's say in India, then many employers, instead of relocating people from the home jurisdiction to India, what they do is they may do a local hire in India to work for those projects in India. So we may have a population which could be treated as a mobile employees or a stranded employees or a local hires. And as Rakesh also mentioned in his introduction, this has created new range of tax complexities for the corporates. So if we look at this background slide, I can bifurcate the reason people are in India into two categories. One, involuntary stay, and second, voluntary stay. When I say involuntary stay, they may be stuck because of the government measures. Say, for example, there was a lockdown, there were flight restrictions, visa expired, and the visa office of the country where they want to go is not open. So there can be reasons beyond their control for which they might be stuck in India. So those reasons we can basket into a involuntary stay. The second reason could be a voluntary stay. Now, voluntary stay could be, as we discussed, reasons that people would have come to, say, India to stay with their families, friends, and work from here. Now, in this pandemic, there is no geography borders. There are no physical offices. Everyone is working from home. So the earlier slide, please. Everyone is working from home. And therefore, there is also a category where people may have come to India and work, and we would categorize them as voluntary stay. We are also seeing a third category, which will be involuntary stay followed with voluntary stay. So, for example, people might have come to India to for a small period of time, but they may have got stranded. That could be involuntary. But then they decided, maybe for a safety reasons or for other reasons, to continue to work from home. So that could be a voluntary reason. Why I'm stressing on this involuntary or a voluntary reason is something that we will see in the later slides. So that's a third category where they may be staying for part of the time involuntarily and part of the time voluntarily. So this could create range of tax issues, starting from corporate tax exposure to employment taxes, and also compliances for the employers. So let's now look at some of those exposures. Next slide. So first one is when an employee of a foreign company is working from India for an extended period, will it trigger a permanent establishment for the employer? Second issue will be, let's say if the directors of the foreign companies or a senior executives are present in India, they are attending board meetings from India, they are taking strategic decisions from India, can it result in place of effective management for that year in India? If so, what is the implications? And lastly, what is the tax implication for those employees who are working from India? So is their salary taxable in India, or are there also obligations on the employers? So broadly, this I would divide the potential tax issues into these three broad categories. Next slide. So before we take a deep dive analysis into each of those categories, let's see what is the journey has been so far and what are the measures taken by various government so far. So point zero, I will say, when pandemic was onset, first time government had to take unprecedented measures like lockdown, travel restrictions, quarantine requirements, etc. Based on this, OECD Secretariat has issued a guidance note on 3rd April 2020. Considering the chaotic scenario, OECD thought it would be best to issue some sort of a guidance note for various jurisdictions to consider what could be the tax implication given this global, given this mobility of the employees. So when OECD issued the guidance note on 3rd April, the thinking of the OECD was this is only a temporary or a transitory phase. It was also being reflected in the guidance note, and the thinking of the OECD in its 3rd April note was, if it's merely a transitory phase, then that should really not create significant differences in the tax implications. Post that, a circular was issued by CBDT. As per the circular, it said that any stranded employees in India, the period from 22nd March to 31 March will be excluded for determination of their residential status in India. Second category, they mentioned that if person has come post 1st March and they were quarantined in India, then the period from the date they were quarantined till they left India or 31 March will be excluded for determination of the residential status of those individuals in India. On 9th May 2020, CBDT also released a press release where they said that they will issue also a similar similar circular for financial year 2021, where they will provide the details of number of days that can be excluded for determination of residential status. In the press release, they mentioned that we don't know when the lockdown will, when the normalization will happen, and therefore we will issue this circular on normalization. Post that, in January 2021, OECD issued a revised guidance note. Now, OECD realized that the lockdowns and the travel restrictions were on and off for most of the 2020, and they were also continuing for 2021. So they took cognizance of the current scenario and updated the guidance note accordingly. We will discuss the views in the guidance note when we are going to deep dive analyze the 3 issues that we discussed. So while, in May 2020, CBDT by wide press release said that it will issue a circular, but no circular was issued, and therefore various representations were being made to CBDT. Also, a petition was filed with the Supreme Court to provide directions in terms of what are the number of days in financial year 2021 that can be excluded for determination of residential status, because that was creating a lot of anxiety with the individuals. They did not know they are resident, non-resident in absence of the guidance of the CBDT. So Supreme Court has issued an order and guided CBDT to issue the circular within 3 weeks. Post that, on 3rd March 2021, CBDT issued a circular for the individuals. It took U-turn as compared to what it promised in the press release. In this circular, which was issued in March 2021, there was no days were excluded. Rather, it gave a different guidance where it said that there is no need to exclude any number of days, and this will this situation of individual taxation will be taken care given the domestic law and tax treaties that India have entered. So we'll also deal with the circular when we talk about individual taxation. So with this, let's start analyzing the permanent establishment implication. Next slide. Next slide. So when we talk about permanent establishment, there are 4 types of permanent establishment that would get impacted because of global mobility. First one, fixed place permanent establishment. So if employees are working from India, now this was a time when employees were working from home. Could this create a fixed place PE in India? Agency PE in India? What happens to the constructions or installation sites? And service PE. So these are the 4 permanent establishments that can get impacted because of this global mobile employees. Let's analyze each of them in little details in the next slides. Next slide. So starting with the fixed place P, in order to create a fixed place permanent establishment, so the definition is a fixed place of business through which business of an enterprise is wholly or partly carried on. In order to create a fixed place PE, there are three key ingredients. First one, disposal test. That will mean company should have a right of disposition over a place. Now, as per this test, no formal or a legal right is required to use a place. But so far as enterprise have a place in India, which is at its disposal, then the disposal test is met. Second is permanence test. Now, OECD commentary provides some guidelines on the permanence test. As per OECD commentary, it says that in order to create a fixed place permanent establishment, a fixed place should be available for a reasonable period of time, and that could be 6 months. Now, this 6-month time period is not necessarily applicable in all scenarios. If there is a business which per se require a shorter period of time, then that shorter period can also create a fixed place. And as held by Supreme Court in the case of Formula One, if entire business activity has been done in India, then a very short period, if the place is available, can also create a fixed place permanent establishment in India. So it is a bit subjective, but if the normal rule is been 6 months, which of course gets depending on the specifics of the business, can be differentiated. And lastly, carrying on business through the fixed place of business. So it's a business test. All the three conditions are cumulative. So in order to create a fixed place permanent establishment, all the three conditions should get satisfied. So let's say, for example, while first and second test are satisfied, but the employees are merely carrying out a preparatory or an auxiliary type of a services from India. Now, there are specific exclusions. If you are carrying only preparatory or auxiliary services, then despite you meeting these conditions, fixed place PE will not be created. So what is the type of services the employee will be performing in India would also be relevant. So as we saw in the pandemic, when people, let's say, came to India and started working from India because their family was in India. So all were working from home. Next slide. So question will be, when employee is working from home, can that home office of the employee create a permanent establishment for the employer in India? Next slide, please. So here I would like to highlight OECD commentary, para 18 and para 19 of the OECD commentary that are relevant. The guideline in the OECD commentary for creation of a home office as a permanent establishment is, the first guideline is whether that home was used on a continuous basis or on an intermittent basis for carrying out business activities. Second important criteria is whether employee was required to use the home for the office. So the condition will be that if employer wants that employee to use the home to conduct the business activities, then it is with the permission of the employer, and therefore that may be at disposal of employer. But if employer do not want the employee to use the home, to work from home, and it actually has provided a separate office to the employee, then para 18 has said that it should not necessarily create a disposal. Vaibhav, can you go to that arrow, please? Vaibhav? Vaibhav, can you go to the arrow? Yeah, thanks. No. Previous slide, please. Previous slide.
Press the arrow, Vaibhav.
Here, this blue arrow, if you can.
Take the cursor to the arrow.
No.
You want to go ahead on the slides and then come back?
Okay, just go back to the slide. Maybe I'll just discuss it. Okay, so basically just go previous slide. Now para 18 really spoke on that, and para 19. So on the arrow, I've just given that OECD commentary. Go to the previous slide, Vaibhav. So para 19 really talks about cross-frontier employee. Previous slide, Vaibhav. Anyway, so para 19 of the OECD commentary talks about cross-frontier workforce. Now, what it says in the OECD is, if a cross-frontier worker perform most of his work from home situated in one state, rather than the office made available by his employer in another state, then one should not consider that home at the disposal of the enterprise, because enterprise did not require that home be used for its business activities. But of course, OECD commentary further added, stating that this may rarely be a practical issue. So while facts may need to be analyzed, but this may rarely be a practical issue. But one important point I want to mention here is, while OECD guidelines also refer to the cross-frontier worker, and their basic comment was it may not create a disposal because it's not at behest of employer, but India has expressed its reservation on para 19 of the OECD commentary, and India in its reservation has mentioned that cross-frontier workers perform most of the work from the home situated in India, rather than from the office made available to him in another country, then home can be considered at the disposal of the enterprise. Let's now look at what the guidance note has provided. So here I've given a text of both the earlier guidance note and an updated guidance note. But in principle, the guidance note said that stay in India is as a result of public health measure. It's an extraordinary requirement and not an enterprise requirement. It further provides that, in absence of the government measures, the employees may not necessarily would have worked from home. And therefore, in this kind of a scenario where employees are working from home because of the public health measures, when we say public health measure, it means the lockdowns and the travel restrictions imposed by the government. So when these employees are working because of the public health measures of the government, the place should not be considered as at a disposal of the employer. updated guidance note also said that if the employee continue to work for a longer period of time after the cessation of the public health measure, then the Home Office may be considered as at the disposal of the employer. So guidance note also has tried to state that if it is primarily stranded employees or involuntary employees who are working from home, it's a better case that it may not be at disposal. But if employees are working for an extended period of time, then so it's a voluntary stay of the employees, then it may possibly be at disposal of employees. Now here, I want to highlight that guidance note is merely a guidance or a framework as to how various jurisdictions can approach this tax issues. Guidance note is not binding on any jurisdiction, including India. Guidance note is an opinion of Secretariat of OECD, and it do not reflect opinion of OECD countries. And in fact, guidance notes say that each country should issue a guidance note to reflect what is the position they want to take when there are stranded employees in India, involuntary employees in India. So so what is the approach governments want to consider? So the point will be, this guidance note is not binding. It's only a framework or a guidance. Various countries have issued a guidance note, but India has not issued any guidance note on this aspect. Only guidance note issued by India was excluding few days for determination of a residential status of individual in month of March 2020. Also, India has expressed its reservation on para 19 of the OECD commentary. So point is, even for the force majeure or where there were lockdowns or travel restrictions and there were stranded employees in India, can a support be taken of this guidance note, and basis that can we argue that those stay should be excluded for determination of permanent establishment? This could be in absence of a specific guidance, it could be litigative, and we will need to see how courts will decide on the matter. But I want to add another argument here for everyone's consideration. Next slide. So I want to talk about a principle. Next slide, Weber. I want to talk about a principle of lex non cogit ad impossibilia. What this principle says is, law cannot compel a man to do what he possibly cannot perform. So fundamental test applied by the court is, if something is beyond a control of the person, it is occurring without the fault of a person, and if it results in impossibility, then the law may need to also be amended accordingly. So I may also quote from a decision of a Bombay High Court in the case of Ganpat Lakshman Talgutkar, where it has succinctly explained this concept. And it said, if court finds the duty either impossible of performance and beyond the normal capacity of a reasonable or a prudent man, or when performance in the strictest language of enactment is either idle or impossible, then the enactment must be understood as dispensing with the strict performance of that duty. I would also like to highlight decision of Delhi High Court in the case of Suresh Nanda. this case law, what happened was federal authorities had unjustifiably impounded the passport of this individual, because of which he was not able to travel. So courts, when analyzing his situation, has observed that this individual was virtually an unwilling resident on Indian soil without his consent and against his will. His involuntary stay during the period that followed till the passport was restored under the court's directive, thus must be excluded for calculating the period under section 61A, which is for determination of his residential status. So we have some judicial analysis to support the principles where it's impossible to do an act. Can law dispense with or give a relaxation in set scenarios? So this principle can possibly be explored for various permanent establishment or the residential scenario where people may be stranded involuntarily in India. But of course, this will need to be tested by the courts. Moving on, next slide. Maybe, okay, so this was broadly on the fixed place permanent establishment. So where if it's for an extended period and with permission of employer, the better argument would be that it is at disposal, but if it is not, then possibly it's not at disposal. Moving on, let's now look at the second permanent establishment, service PE. Service PE is constituted if there's a services furnished by an enterprise in India through its employee or other personnel, and that activity continue in India for a period exceeding the days as specified. Now, different treaties may have a different threshold. What I've done is I would rather explain the concept of a service permanent establishment with an example. Let's take a case. Mr. A is an employee of X Limited. A started rendering services in India from 1st March 2020, and he was scheduled to depart on 15th April 2020. However, due to nationwide lockdown, he was stranded in India. Further, from 20th March to 31 May, no services were rendered to the clients. He again resumed services from 1st June, and he chose to work from India from 1st June to 31 July instead of USA as a safety measure. So let's analyze the service permanent establishment under different scenarios. So just to summarize the facts for everyone's benefit, the employee was in India for in total 153 days from 1st March to 31 July. He was working for 19 days in March and then started working again from June. So he was working in total for 80 days, and he was not providing services in between for 73 days. Let's assume the treaty that we are analyzing, the threshold is 120 days in any 12 months. When we say any 12 months, it really will look at the 12-month time period and will not bifurcate between the financial years. So let's analyze whether these facts can create a service permanent establishment under few scenarios. First scenario, if he is providing services only to his employer. So he's providing internal services. He is not providing services to any third party in India. While his overall stay was 153 days, can this facts create a service permanent establishment in India? I'll give half a minute for you all to think, and then I'll answer it. Earlier slide, please. Weber, earlier slide, please. Earlier slide, please. Earlier, thanks. Please stay here. Well, as per OECD commentary, it provides that it is furnishing of services, and furnishing of services presupposes that the services are provided to third party. So in a scenario where services are not provided to any third party, there can be a possible argument that it may not create a service permanent establishment. Now let's look at a second situation where employee was present in India for 153 days, providing services for 80 days, not providing services for 73 days, and the services were provided to third party. Can he create a service permanent establishment in India? Now here again, based on the OECD commentary and the guidance provided therein, it says that the services should be provided by an enterprise and not individual. It also indicates that it's the days when the services are actually provided should be considered. Basis their argument, there can be a possible argument that since services were provided only for 80 days and it did not reach that 120-day threshold, there can be a possible argument that in that scenario, service PE may not be triggered. Third scenario is a combination. In the combination, if he's also providing third-party services, then I would say the better analysis would be as same as was discussed for services to third party. Now, one important aspect in this will be if the employee is not providing services in intermittent time, then there has to be a documentary evidence to support that. And that would be critical to say that no services were provided during that period of time. Moving on to the next slide. Moving on to the next category of permanent establishment, that is agency PE. Now, a question may arise in our mind that agency PE is triggered when an agent is acting in India for a foreign enterprise. Can employee be an agent? So OECD commentary has in fact provided that employee will always be considered as a dependent agent. So if employee is present in India and he is habitually concluding contracts in India on behalf of a foreign enterprise, then he can also create an exposure of agency permanent establishment for employer in India. Also, since he's an employee, it's very difficult for him to prove that he's an independent. Next slide. The question will be, if the employee is in India for a temporary period or a transitory period, can he create a dependent agent permanent establishment in India? Now here I will again refer to the OECD guidance, and there are two key aspects. One is habitually concluding contracts. Rebecca, can you go to previous slide, please? So when we say the word concluding contracts, One aspect is, even if all the elements of that contracts are being negotiated by the person and merely the signing is happening by a foreign enterprise, so that negotiation can also be considered as a concluding contracts. So one may also need to assess the facts, what that employee is doing. So if he's concluding all the terms of those contracts, it could equate with concluding contracts. Second is, in agency permanent establishment, the word used is, he is habitually concluding contracts. So what is the meaning of habitual? Now that term habitual has been explained in the OECD commentary, and they have said that habitually should mean usually, ordinarily, and they also have expressed that there should also be certain degree of permanence. And for the degree of permanence, they have referred to the test which was that we discussed for the fixed place PE constitution. So similar degree of permanence will also need to be evaluated for, earlier slide please, will also need to be evaluated for the agency permanent establishment. So it's only rare scenario where fixed place PE is not created because of the stay. But since employees also concluding contracts, it may also give rise to a agency PE. Very likely fixed place PE may also trigger in this kind of a scenarios, but this is also an area one needs to keep in mind. Next slide. So let's move to the last permanent establishment, which is a construction PE. Now, as per OECD, a building site or construction or an installation or assembly project or a supervisory activities connected with such site can create a PE if this site continues for a period more than the days as specified. As per OECD model convention, it says that if the site is available for more than 12 months, then it creates a construction PE. The key aspect here is the site should be available for the period specified in the threshold. Now, it really do not make a difference the work has been done or not. So it's linked to the availability of that website, sorry, of that site. So for example, let's say there's a contract for construction of a building. Now, if this, and the threshold is 12 months. So if this building is constructed within, say, 10 months period, then there may be no construction PE. But if the site of that building is available to the foreign enterprise for, let's say, 14 months, it has breached the threshold of 12 months, and then the construction site will be considered as a permanent establishment for the foreign enterprise. Now, this has created various issues because of pandemic. Now, during the pandemic, as we all aware, there were various situations, starting right from a complete lockdown. So there was no work on the construction site for, say, few months when lockdown was in place. Second issue faced was non-availability of the workers. So let's say the foreign enterprise may be wanting 100 workers on the site, but because of the pandemic scenario, they may have only 40 workers. So the work was carried on, was very slow, and therefore, of course, it takes more time to complete that project. There could also be possibilities that, let's say, if it's an essential service, then they may have more workers. But if it is non-essential services, then the worker requirement can be less. So there were various challenges that were being faced during this pandemic, where work was on and off in those construction sites. So moot question for consideration will be, let's say when there's a lockdown and no work was happening on the site, can that period be excluded for determination of the permanent establishment? But here the guidance in a OECD is, and especially for the construction permanent establishment, it says, if a site is not available for a temporary period, or it is ceased to operate for a temporary period, that temporary period will not be excluded for determination of the permanent establishment. In fact, they also gave an example that there are seasonal or other temporary interruptions, there are bad weather. Because of this, it's been discontinued. Still, the time period needs to be calculated. There's no bright line test mentioned in the OECD commentary, but the example they gave, and there, because of a bad weather, the site was not functioning for almost 3 months. In that scenario also, they said that this 3 months will not be excluded for determination of a construction permanent establishment. In fact, there are a guidance note issued by various countries, and while some countries like Germany, subject to certain conditions, have agreed to exclude the period when the site was non-functional because of COVID. But there are also countries like Greece, Austria, where they have specifically mentioned that the temporary disruptions of the site due to pandemic will not be considered. So that temporary disruption period will also add to determine the time period for the determination of the construction permanent establishment. Now, in absence of any guidance note issued by India, it would be therefore very difficult to exclude those kind of temporary discontinuation for determination of construction permanent establishment in India. With this, the basic discussion on construction for permanent establishment is completed. Maybe what we'll do is, before we move on to the next one, let's just take up one case study just to understand the principles. Next slide. Next slide, Pepper. Thanks. So in this facts of the case, ABC is a company incorporated in and a tax resident of Canada. It is engaged in providing investment management services. Miss P is an Indian citizen and employee of Canadian company, and she used to work from Canada. Her roles were limited to providing internal services to ABC. Now, Miss P arrived in India on 4th November to spend time with her family for a couple of months. However, due to COVID-19 pandemic lockdown, Miss P was in India till 28th May 2021. Further, Miss P was in India for more than 365 days in the past 4 tax years. Next slide. So Miss P has been working for ABC remotely in India from 4th November to 28th May from her residential house. ABC do not have any Indian subsidiary or a group company or a place of business in India. The question for determination will be, since Miss P is working from India from 4th November to 28th May, which is around 209 days, can Miss P create a permanent establishment exposure for ABC in India. So maybe some facts. Miss P was in India in total for 209 days. We are aware that there was a second wave. And let's assume there was a restriction for the period from March to May for 92 days. So out of total 209 days, 92 days was a lockdown. And if we exclude 92 days, it becomes 117 days. So question will be, first question is, can we exclude this 92 days considering force majeure provisions or a principle of non ad cogitum possibilia, and exclude those days for determination of permanent establishment of ABC? Now, these are the principles untested today. So we will have to see how courts decide and how courts take in cognizance this aspect. But one thing that will be very, very critical if one wants to take a argument of force majeure will be, what is the documentary evidence to show that the employee was stranded in India and the employee was forced and couldn't go despite the choice, despite the fact that employee wanted to travel back. So those documentary evidence will become very, very critical to demonstrate that there was actually a force majeure and employee was prohibited from traveling back to their home country and they were stranded in India. Another issue that may need to be evaluated here will be, as we discussed, home office, a disposal test needs to be met. So what happens if Ms. P was working from home office in India, let's say, with approval or without approval of the employer? Let's say Ms. P informed the employer that she's traveling to India and she will be working from India. Employer may not have, restricted to this proposition. Can one say in that scenario, employer has implicitly agreed with the proposition for Ms. P to work from home office in India, and therefore it was at request of enterprise that Ms. P was working from India, and therefore that condition should also be satisfied, and therefore office is available at disposal of ABC in India. But instead, let's say Ms. P just came to India without informing the employer, and she's working from India because today nobody is fixed to a geographic location. Then can one argue that it was not at disposal of employer? These are tricky questions and needs to be documented well if one wants to take such sort of arguments. So with this, I will move on. So maybe just to conclude, of course, permanent establishments are fact specific. Each fact needs to be analyzed and appropriate documentation needs to be maintained depending on the position you want to take. One may also need to evaluate whether they are for the extended period of time or they were stranded only for a shorter period of time. So the implications could be different if they are for an extended period of time, vis-a-vis they were only for a period of time when there was a force majeure. With this, let's look at the second topic, which is dealing with place of effective management. Next slide. Next slide, please. So as we all are aware, as per Section 6, a company is considered as resident in India if place of effective management is in India. in that year. And place of effective management has been defined as where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole in substance are made. Of course, determination of poem is based on the facts and circumstances of each case. It's a fact specific exercise. But let's take a scenario where, say, a majority of the board of directors are stranded in India. And they are taking decisions. They are attending board meetings from India. They are taking strategic decisions from India. Then what will be the impact on place of effective management in India? Because the issue will be, if it is held that foreign enterprise is considered as having a place of effective management in that year in India, it will be considered as a resident in India, subject to taxes at the rate of 40%, not at the rate of 22 or 25 or 30%. That is available for Indian company. So the consequences or implications could be significant, where global income getting subjected to tax in India at a higher rate of tax. Again, let's analyze if the key managerial personnel are in India for, say, 3 months, 6 months, or 9 months. Depending on a time period, can there be a different analysis? Say they are 3 months in India and 9 months in their home country. They attended 1 board meeting in India and 3 board meetings in their home country. In that case, it's a better case to argue that since for most period of time, they took decisions from their home country, and it's only for a temporary or a transitory period they were in India. And if we can add the arguments of the force majeure, then it should be a good case that they may not create an effective management in India. Now, as opposed to that, let's say for 9 months they were in India and 3 months they were in their home country. Now here, a lot of facts and situations will need to be analyzed. They were voluntarily or involuntarily staying in India. What are the decisions taken by them in India? Have they taken, were they taking, attending board meetings, taking strategic decisions in India? What are other key personnel outside India? So all these parameters will need to be evaluated, but it could be a difficult situations to justify that the POM was outside India if majority of their senior personnel are from India for a 9 months time period. Now let's take a case of a 6 months. So 6 months in India and 6 months in their home country. What happens in that? Now, in that scenario, let's say they also qualify, this company is a resident both in India and outside India, based on the law of each of the country. So most of the tax treaty also provides for a tiebreaker test, where again, the criteria for tiebreaker test for the company is place of effective management. But when we look at the criteria in the treaty, they have also laid down some of the principles that may be considered for analyzing a treaty POEM criteria. Now, they may consider scenarios like where key management and commercial decisions necessary for conduct of business as a whole were made. Where is the chief executive officer is based? Where are other senior executives usually carry on their activities? Where is senior day-to-day management of the activities is carried on? Where the headquarters are located? So there are various principles that would be applied. But if there are tiebreaker tests, various aspects will need to be considered. And it's good to document each of those aspects just to be sure for corporates to evaluate and analyze where their place of effective management could be. Situation could become more challenging when in the tax treaty, it says that when there's a tiebreaker test, and this tiebreaker test will be evaluated by a competent authority. Now, when the only criteria is a competent authority will decide where the place of effective management is, it could be time consuming and may take a lot of time to get a decision on in which country the place of effective management is. With this, I'll move on to the next subject, that is on individual taxation. Next slide. Next slide. So next issue will be what happens to the taxability of these employees who are working from India. As per section 912 of the Act, salary is deemed to accrue or arise in India if it is earned in India, and it is considered as earned in India if services are rendered in India. There are also various judicial decisions, and it's a settled principle that if physically they are providing services from India, then salary will be considered as taxable in India. And this is applicable independent of the residential status or where the salary is paid. So even if an individual qualifies as a non-resident and the salary is paid to him in his home country, since he is physically providing services from India, that salary will be taxable in India. Next slide. But the provision also provides for a short stay exemption, what we call it as a 90-day rule. The condition to claim a short stay exemption under Income Tax Act are, first, this person should be a foreign citizen. So the short stay exemption is not available if the individual is an Indian citizen. So for example, Indian citizen working abroad, his normal place is abroad, but during the pandemic, this person came to India and working from home just to stay with their families. So this short stay exemption under Income Tax Act will not be available to this individual because he's an Indian citizen. So per se on that ground, short stay exemption will be out. Second condition is foreign entity is not engaged in trade or business in India, stays less than 90 days in a year, and remuneration is not liable to be deducted from employer's income chargeable to tax in India. So provisions of short stay exemptions are a bit like a chicken and egg situation, if I may say, because the presence of employee can create a business or a trade for the employer in India. And if it creates a business or a trade for the employer in India, then this exemption is not available. So both the aspect needs to be analyzed. So first, possibly you may need to analyze the foreign entity aspect, whether it's considered as having a trade or a business in India. If yes, then the short stay exemption is not available. If not, in that scenario, only short stay exemption is available. So let's say this foreign enterprise, they have 3 employees coming to India. Each stayed in a different time period for, say, 4 months each. So 4 month one employee, next 4 month another employee, and the next 4 month third employee. So in aggregate, entire year, the employees were working for the enterprise in India. And let's say basis that it's held that this enterprise has a P in India. If so, then the short stay exemption may not be available. Now, there are also certain exemptions available under the tax treaty. Next slide. Now, to determine the exemption available under the tax treaty, we may first need to assess the residential status of this individual under the tax treaty. Next slide, please. So let's say, the individual is staying in India for 200 days and he becomes resident in India. In his home country, the criteria for selection of residence is not number of days, but different criteria, like US. So in US, the criteria is citizenship. And therefore, this individual is also a resident of US. Now, in this situation, it's possible that the individual may qualify as resident of both India and USA. So how do you resolve these situations where they may qualify as a resident of two countries? Again, Dutch treaty provides for a tiebreaker test to resolve this kind of a scenario. And basis tiebreaker rule for the provisions of the tax treaty, we may say that this individual is resident of that country where we could determine basis the tiebreaker rules. So tiebreaker provides typically for 4 conditions. First one is availability of a permanent home. When we say permanent home, the rule is whether a home is available for a long-term period, say more than 12 months. Now, there can be various scenarios. So he may have a home available where he's usually working, say USA. And he may also have a home in India. Let's say he's a citizen of India. And so therefore, he may have bought and kept a home in India. Or he might have taken a home on a long-term lease in India. Long-term lease is also regarded as a permanent home. So there's a possibility that he may have home available in both the countries. If so, then we cannot tie break on basis of this test. We'll have to go to the second test. Second test is center of vital interest. When we talk vital interest, the key aspect is where the social and economic interest of that individual is. Economic interest could be equated with employment. Social interest could be equated with where the families, friends, and social circle is. Let's say this person's economic interest is in USA because he's employed by a US enterprise. And his social interest is in India because his family, friends are based in India. If so, again, we will not be able to tie break on this condition because it's 50-50. In that case, we might have to look at the third condition, which is habitual abode. Habitual abode is a very subjective criteria, I will say. OECD commentary also gives some guidance on where we can say is a habitual abode. It says that for determining a habitual abode, one needs to evaluate where an individual is customarily or usually present. So one needs to look at the frequency, duration, regularity of a stay that are part of a settled routine of an individual life and not merely transient or temporary to define where the habitual abode would be. So earlier slide, please. Two key aspects in habitual abode is, do we look at where individual intends to be settling, or do we look at the time period he has spent in that year for the determination of a habitual abode? And last, if we are not able to decide on habitual abode, then last is a nationality. So one needs to really go through this tiebreaker test to determine where the residential status of the individual will be. Basis that, a relief can be claimed under the tax treaty. Next slide. So, next slide. So, under tax treaty, article dealing with income from employment is relevant. Both the clauses of Article 15, 1 and 2 are critical. When we say Article 15(1), now it says that salary will be taxable by a resident state unless the employment is exercised in another state. So let's take an example. The individual under tiebreaker test qualify as a resident of India, he's working in India? If so, it says wages or other remuneration derived by a resident of India in respect of employment shall be taxable only in India unless employment is exercised in, let's say, US. If the employment is so exercised, it may also be taxed in US. In this scenario, it is possible to argue that since employment income is, if he qualifies a resident of India under tiebreaker test, and he is providing services physically from India, then this employment income should be taxable only in India. But let's say he qualify as a resident of other country, example, US, under the tiebreaker test, then Article 15.2 will become relevant. As per Article 2, it says that remuneration derived by resident of, say, US in respect of employment exercised in, say, India shall be taxable only in US if following conditions are satisfied. Now, two conditions are critical here. First, the stay should be only for 183 days. So what happens if he is present for 200 days? This criteria may, this test may not be satisfied. And second criteria is the condition 2C. Remuneration is not borne by a permanent establishment which the employer has in other state. Again, as we discussed under the provision of Income Tax Act, it's a chicken and egg situation. If because of the presence of employees, foreign enterprise has created a permanent establishment in India, and remuneration is claimed as a deduction in order to compute the taxability of that permanent establishment in India, then the short stay exemption will not be available. So these are some of the aspects one needs to consider when they evaluate the taxability of an individual in India. Next slide. Generally, when we look at individual taxation, next slide, please. Individuals should not be doubly taxed because there are provisions to eliminate the double tax. Either there will be an exemption method available or a credit method available. So when we talk about exemption method, we saw Article 15.1, where it is taxable, is a resident and also exercising employment only in a resident state, then only that state has a right to tax it. Other state may not have a right to tax it. So only one state has a right to tax. But let's take another case where he qualifies a resident of another country, not eligible for short stay, and salary is taxable in India. Salary may also be taxable in his home country, let's say US. Now in those scenarios, since he was tie-break to USA, USA may possibly give him credit for the taxes paid in India. So for example, say his tax liability in India is 30. His tax liability in USA is say 35. So when US tax will need to be considered, it will be 35 minus taxes paid in India, 5. So there are provisions under the tax treaty to take care of this kind of a double tax nuances, and therefore the taxability may be only in one country. So I mentioned earlier that, next slide, please. So I mentioned earlier that, in 9th May 2020, in a press release, CBDT said that they will also provide a similar relaxation for exclusion of a number of days for financial year 2021, when normalization will be attained. But when circular 2 of 21 was issued in March 2021. No such relaxation was provided. So basically, when CBDT analyzed this issue again in month of March 2021, they considered 5 aspects. First, determination of residential status. And again, they considered or evaluated if he's a citizen of India or not a citizen of India. And in their opinion, they said that if it's a short stay, so if the individual is staying for less than 182 days, and he's a non-resident coming for the first time in India, it is unlikely that the person will qualify as a resident in India. Second scenario, they said that even if they qualify as a resident in India and resident of another country, there's a tiebreaker test provided under the tax treaty to resolve this kind of situation. Next, they relied on Article 15, where it said that the treaty also provides for certain exemption that, either you get an exemption or a short stay exemption, or otherwise you have a foreign tax credit mechanism to resolve the double taxation situation. The fear that CBDT had was if we exclude certain number of stay, an individual become non-resident in India, and he's also non-resident in another country. Let's say this country, for example, UK, also decides residential status based on number of days stay. So the individual will be non-resident in India as well as in UK. That could create possibly a non-taxation, non-double taxation situation, and hence it's decided not to provide any relief. Also, it evaluated some of the international experiences, and there are countries where they have provided a guidance note and they have clarified that they will not exclude any of the stays for determination of the residential status in their countries. So India has also taken a cue from that and decided not to exclude. Next slide. But while, they considered this, it forgot to really took cognizance of some of the scenarios. I'm mindful of a time, so I'll go very quickly here. Now, what happens in this situation is individual will be taxable at a rate which is higher of both the countries. So let's take a cases where NRIs from countries like Oman, Qatar, UAE are stranded in India. In UAE, they pay 0 rate taxes, whereas in India, the tax rate could be as high as 30% or 42%, depending on their income taxable in India. Similarly, say Singapore or other countries where the tax rate is lower than India, they will be saddled with a higher rate of tax in that year. Again, they've not resolved what happens if individual, because of these situations, qualify as a resident and ordinary resident in India. So individual may have planned to leave country in early 2020 so that they do not qualify as ROR in India. But because of this situation, they may be stranded and become ROR subjected to global tax income taxable in India. So those situations has not also been considered. Next slide. Before I close, I just want to highlight one issue. These are just dealing with certain compliances. Next slide. I'll take only 2-3 more minutes, Rakesh.
Yeah.
So this slide, I just wanted to highlight by way of an example, a case study. Maybe I'll summarize the facts for the benefit of everyone. Here, Mr. X was present in India for in totality 226 days. Out of this 226 days, initial days, so he came in India on 8th March when there was a lockdown, but for the safety measures, the individual thought of staying in India until 9th November. So in totality, he was for 226 days in India. If on the principles of force majeure, we exclude the period where there was a lockdown, etc., the total number of days may come down to less than 183 days. Question here will be, can we exclude the initial days when there was a lockdown to calculate the period of 183 days? Here, I want to leave everyone with one thought. When we talk about force majeure provisions, when we talk about involuntary stay, do one needs to look at a holistic scenario? So for example, in this case, initial period, there was a lockdown, but this individual stayed until November. Was there an impact of a force majeure provision? I mean, even if there was a force majeure, this person is in India until 9th November. So how force majeure is impacting the individual? Is this force majeure creating some impossibility for him? So he's just trying to take the provision to his benefit, but is force majeure really impacting his stay in India if he is voluntarily staying in India? So I just wanted to leave this thought that force majeure provisions cannot be necessarily applied in all scenarios. One may also need to look at how this force majeure provisions are impacting the situations and the facts of each case, and how it really can be proved that it forced the person to stay in India before we kind of take cognizance of this kind of provisions. With this, I hand over back to you, Rakesh. Dot on time.
Thank you, Hema. You are dot on time. But if you permit, and there are a lot of questions coming, maybe if it's okay with you, maybe we can ask 1-2 questions before
Sure.
the participants can go. So the first question that is being asked is whether a business visa, employment visa, or a tourist visa makes a difference for PE and also for individual taxation.
So it will not make any difference for individual taxation, because the only criteria for individual taxation is services are rendered physically from India.
Okay.
When we look at employment taxation or a permanent establishment, if the person is on employment visa, it actually strengthens the case of department to argue that the person came to India to work from India with the permission of the employer. But if he's on a tourist visa or other visa, there can possibly be an argument for otherwise.
Okay.
So that those are some nuances one can take into account for documentary evidence, but none are conclusive.
Okay.
Ultimately, it's a test of disposal.
Thank you. There's another question from CA Ajit Mehta, where it says that form for a non-resident is submitted by an individual in pursuance of CBDT circular. If CBDT does not respond to the form by the due date of filing return, can it be assumed that the claim of non-resident status is accepted?
I would say it will be a very, very aggressive position.
Okay. Okay. Last question. What documents should be mentioned for or maintained for involuntary stay, and whether they are to be filed with the tax return or to be kept with the taxpayer till the assessment comes up?
So documentation that you would want to maintain will be depending on the facts of each case, but some sort of a documentation that can be considered is, say, the person had tickets for the travel and there were no travel available, or the flights were cancelled, and maybe certain correspondences that I am wanting to come to my home country back, but I am stranded in absence of any flight availability. So anything that will add to support the facts of your case, those should be maintained. There is no provision to submit these documents with a return of income. Therefore, one will need to maintain it, keep it on record, and this will be relevant when there is an assessment.
Okay, thank you. Thank you. We have overshot the time. Thanks, Hema ma'am. Let me request CA Deepika to give a hearty vote of thanks.
Good afternoon, everyone. I'm CA Deepika Gurgutia. I'm here to give a formal vote of thanks. First of all, I would like to thank CA Hema Lohiya for giving us so information and enlightening us on such a topic, which is a need of our with the emerging global markets and easy mobility. Thank you, ma'am, so much. And I would also like to thank all the members for joining today's session and making it a great success. Thank you.
Thank you. Thank you, Deepika. So see you all at our tomorrow's last 2 sessions. Looking forward to rejoin with you again. Thank you. And thank you, Hema ma'am, once again.
Thank you. Thank you, everyone.
Bye.
Bye.